All right. Welcome, everybody, to the Ultimate Advisors Resource Podcast. I'm Jordan.Pence with Advisors Resource Company. We help advisors like you write more life insurance and annuity business. And so today we've got one of, I think, the best tax planning ideas that's out there. And this is really split dollars, what we're talking about, loan regime split dollar. But if you take a step back and really think about this, it's actually kind of entity planning and leveraging entity planning with insurance and utilizing entity planning to fund your insurance. So we've got a great agenda today. Feel free to use the Q&A while we're in here. I'm happy to answer any questions or thoughts or whatever as I go through this. But I'm gonna just go right into it and we'll get started. So I got my PowerPoint up. Let me change the screens here and we'll get going. Okay. So my objective today is really by the end of this session, I'm hoping everybody will be able to just simply identify business owners that may benefit from this type of planning. I'm going to briefly touch on why some of the traditional options like qualified plans and things like that might be inadequate or not work for not fully provide the benefits that your clients probably want. Secondarily, just go over basic how split dollar works, that sort of thing. Recognize when a C Corp can help out, and then really know when our firm, Advisors Resource Company, we work with a CPA firm named HST. And actually at our lunch and learn that we did, we had Symetra there as well. We really like their IUL. I'm not going to go into that on this PowerPoint or this session, but we will be having them on at a later date. But our goal is that you have 2 or 3 clients that you can think of, write them down, and then let's visit afterwards and let's talk about them and see if we can't come up with some opportunities with your clients to write this type of business or implement these types of strategies. So before I get into too much details, what I want to talk about is I want to just briefly go over our firm, what we do, what I think separates us. Advisors Resource Company, we're an IMO, BGA, whatever vernacular, whatever buzzword you want to use for us. That is what we are. What we do or what we have is what we call our premier producer process. And so what that really means is we do 5 things. First thing is we're going to help you uncover opportunities through our expertise. Second thing we do is we're going to help you with case design and consultation. Third thing we do is we put together tailored yet simple client presentations. So what that really means is we're going to not give you just a carrier illustration. We're going to give you something that's branded to you, something that's easier to explain, easier to understand, that sort of thing. Lastly, I'm going to just turn this mic down a little bit. I hope it's not blowing you guys out of here. The last thing that we're going to do is, and just tell me if you can't hear me, please send me a message. The last thing we're going to do is we do underwriting support. So obviously ordering all the medical records, ordering all that stuff. We do all that. But what I'm really talking about with regard to that is when you have a case, it's over $5,000 target premium, we take the app on your behalf. And finally, we do enforced policy management. So we've got a system that pulls in all the policies that are written through us, and you can see those all in one spot. But we also have a service team. So you email our service team, they'll fill out the DocuSign for your clients to whatever, change the beneficiary, etc. One last thing that I'm going to touch on is we are rolling out our annuity resource center. Now this is going to be a learning center, so it's going to have the training requirement, marketing materials, all that stuff. It's going to have a product marketplace where you can compare all the annuity options to each other and find products that are suitable or appropriate for your clients. And then, um, in addition to that, it has a life cycle management service. So, what this is it'll actually feed in all the policies or all the annuities that are written through us so that that you're able to review those. So, anyways, let's get into tax planning. Why tax planning? I think it provides you as the advisor a significant competitive advantage to getting more clients, to getting more business from your clients, et cetera. So I pulled up this stat. This is from, I think it was PNC Bank. And they said in their survey, 82% of business owners say that they would benefit from additional expert guidance on tax related decisions. So, what that means to me is we can, the collective we, everybody in here can benefit their business owner clients or even get more business owner clients. Because if 82% feel like they need more tax advice, that means almost everybody isn't providing very much tax advice. I think it's a huge opportunity. So, what's the problem? The problem is business owners feel like they pay way too much in taxes. And what I think the traditional quote unquote planning options, I think might be inadequate in general. And what am I talking about traditional planning options? Number one, qualified plans, right? Almost everybody gets advice to get a deduction by doing a SEP or a simple or an IRA or 401k or a cash balance plan or whatever. The downside to all of these is if you actually have employees, you have to include all your employees, and that has a cost and it can be expensive and so forth. Second piece of advice is do an S corp. I mean that might be great for when you're making a couple 100,000, but as your income grows, this could be challenging, right? Everything flows through to you personally. You pay potentially top tax on it. It's not ideal. Second piece of advice, which unless you need a vehicle, this is I think stupid advice, is to buy a depreciating asset like a vehicle, um, and get a bonus depreciation or something like that. I mean, this is literally kicking the can down the road, and worse, you're buying something that's not going to grow in value. Deferred compensation. This is great for golden handcuffs for your employees, but it's a wash for a business owner. There's no reason to do that. And then finally, non-qualified plans, right? Non-qualified plans great, but it doesn't affect your tax situation. And in fact, if it's not life insurance, it can make your tax situation worse as those things grow. So these solutions, the issue is they might not fully address tax efficiency, executive benefits, long term wealth accumulation, protecting the business, so forth. So let's start over from the beginning. And that is most business owners that you run across are going to be an S Corp, right? If you're anything like, if your business owners are anything like 95% of the business owners that that we run into, they're an S Corp. Almost all of them are. So the benefits of the S corp, it's great when you're starting out. When you start making a little bit of money, you're taking it all out of the company for income. You're making a couple 100,000. Now I can segregate part of the income as W-2 wages. I have to pay payroll tax on that, but then I avoid payroll tax on the K-1 distribution. Now this is great. And the reason it's great is because I, again, bypass the payroll tax, right? Everything flows through. You got to pay self employment tax, that sort of thing. The negative to this is if I am earning more than what I'm consuming, there's a real probability that I'm paying more than I need to in taxes. And what I mean by that is in this circumstance, I made $1 million regardless of what I do with the money inside the business, all that million is going to flow to me personally, and I'm going to pay personal income tax on it. So, what are the other options out there? Well, you could do a C Corp. I'm going to address the double tax, so don't start yelling at me yet, but we'll get to the double tax. But I just want you to understand C Corps pay their own taxes. So if I have the same $1 million of income in a C Corp, I'm going to send some of that out on a W 2. But whatever I keep inside that C Corp, as of the Tax Cuts and Jobs Act of 2017, is going to stay in the C Corp and it's going to be taxed at the 21%. Now, just to be clear, the Tax Cuts and Jobs Act didn't create C Corps. C Corps have always been around. It changed how they were taxed. They changed it to a flat tax. Before that, Tax Cuts and Jobs Act of 2017, it was pretty aggressive. It was like 15% on the first 50, and then 25 of the next 15, or 25, something like that. But it got very expensive very quickly because you start climbing brackets. Well, now make $1 million or $1, 21%. So, what happens if I compare the after-tax dollars of the C Corp versus the S Corp? So if I have $1.26 of profit in a C Corp, that nets down to $1. So in a C Corp, I only need to earn $1.26, whereas in my S Corp or pass-through entity, so I'm not saying S Corps are bad, but any pass-through entity, if I earn $1.59 and I'm in the highest tax bracket, that nets down to $1. That's a 33-cent difference in how much I need to earn in order to have the same dollar after tax. That's a massive difference. And so the question that I sometimes get is, why doesn't everybody be a C Corp? Well, okay, part of that is the double tax, right? And this is why I preferenced this in the beginning, which if you're consuming all of what you're earning, meaning you're spending every dollar that you're earning, this is not going to work for you. You might as well just hang up right now and move on. But if you are saving more than what you're spending, or you're saving some of what you're earning, i.e. not spending it, this could work. So let's talk about the double tax, right? You bring up a C Corp. Your CPA is going to say, but they're double taxed. Yes, they're double taxed. I get it. It's only double taxed if you distribute the money personally. So let's make sure that's clear. But to follow up on this discussion, it's not like it's 21 plus 20. That's what I think I'm just trying to make everybody understand. It's basically the same as ordinary income. So if I have 100,000 of C Corp, $100 of C Corp tax, 21% of that is $21. So that nets to $79. If I dividend all of that out and pay 20% dividend tax, 20% of 79 is $15.80. Bottom line, I have $63.20. That's actually about 37% in tax, which ironically is exactly the same as recognizing the money personally. So, yeah, double tax is a problem, but is it that big of a problem? Not really. All right. So, Jordan, what am I supposed to do? You're telling me to convert my S Corp to a C Corp? I should only do C Corps? What is the point? No, the point is we should do a hybrid solution. Now, really what this is this next slide, right? So what I'm telling you to do, Mr. Business Owner, is let's bifurcate your business. Let's set up a C Corp next to your operating entity, your LLC, your S Corp, whatever it is. And let's move some of your profits plus expenses from the S Corp to the C Corp. So I'm going to move 126,000 plus the expenses associated with that. And why I'm saying that plus expenses is because that C corp or MSO has to have some sort of business purpose, marketing, management. I can move all the business functions into the C corp and leave some profit in the S corp. We do whatever. But again, that's up to us, the collective we, and the business owner, the CPA, other professionals, and help them try to figure that out. But moving on from there, we put 126,000 into the C corp, pay 21% tax. That nets down to 100,000. I move. I keep everything else the same, and I end up saving roughly 25,000 in taxes by doing this. Well, you're probably thinking, okay, this is a lot of moving parts, a lot of confusion. Where's the insurance? Number one. And you just talked about double tax and how I end up in the same spot with double tax. So, what do we do with that money that's now in the C Corp? So, I'm going to pause here, take a sip of coffee. If you have any questions, type them in. But this is step one of two. And what we want to do is create after tax income after tax dollars inside the C Corp. And then we're going to use that money to fund the insurance. And I'll show you exactly how. So, what are we going to do with the 100,000, Jordan? All right. So, what we're going to do is we're going to take that after tax money. We're going to set up a equity transfer strategy or a split dollar strategy. And we're going to take the 100,000, we're going to put it into an insurance policy that's owned by the business owner. Now we're going to collaterally assign that back to the C corporation. This 100,000 is actually a loan. We're considering it a loan on the books of the C corp. Now, what have I done? I've got this insurance policy. I put 100,000 in it from the C corp. By the way, that's not a taxable event. And now I personally get the growth on that policy with no tax consequences. You see, if I've got after tax dollars in the C corp, I could invest it in the C corp. If I invested it in the C corp, now I created a bigger double tax problem, right? If the 100 grows to 200, now I got to pay dividend tax on 200. I created a problem. Whereas this, I take the 100, put it in the life insurance policy. The 100 grows to 200. Now I have 100,000 tax free in my pocket, not in the C corp's pocket, in my pocket. Now, of course, there's a little bit of economic benefit tax, right? So because the business owner is using this money, the C corp's money, then, we get a little bit of there's a little bit of economic benefit there. So you got to pay a little bit of tax on it. But this is a huge benefit. So what I always compare this to is, I've got a ledger here, but I'm going to compare this to a qualified plan. So in this example, we're assuming 253,000 of pre-tax dollars. Inside the C corp, that nets down to 200,000. If I wanted to put that same 253,000 into a qualified plan, I'm assuming that I would have to put about 10% of that 250,000 into my employees' 401k or their plan or whatever, contribution for employees, and I would have some admin costs associated to that. So going into the business owner's account would be about 227,000. And so I'm putting this money in for a 10-year period. Look at the difference in the income. You're talking about 290,000 versus 172,000. It's huge. It's huge. I mean, this is almost double the amount of income that you can take out. So what are the differences, right? What are we really talking to? Why does this work so well? So the big benefit of the equity transfer, I guess the negative, right? Part of it is I'm going to pay half the tax now. I'm going to pay half the tax now. Okay, I'm paying less in tax, 21%. but there's no tax on the growth, and the rest of the tax, meaning, I paid half tax now, so I got to pay a dividend tax later on. That's only on the actual basis. It's not on what it grew to. And furthermore, I can time those payments. I can time when that tax is due. Now, if I compare that to a qualified plan, you pay no tax now. It's going to grow tax deferred, but I'm going to pay tax on everything when I take it out. Furthermore, I don't get to choose when I take the money out because I have RMDs. So the final point to all of this is, okay, this is great and all. I've got this deferred dividend potential problem in the future. What do I do with that? Number one. So how do I get out of the C Corp, right? So, and this is a little bit confusing, but as you build up money in the C Corp still owns what it puts in. The business owner owns the growth on it. So at some point you have to deal with that amount of money that the C Corp owns. All right. So one way of doing it, you pay it back on death, like you could die with it. You could do a lump sum rollout, or we could do what's called a crawl out. We could do it out over time. So if you die with it, this is arguably the most tax efficient way. In my example, the total death benefit was 4.6 million. If I die with it, my family gets 2.6 million. The MSO or the C Corp gets 2 million. That pays off the loan at the C Corp, and the MSO dissolves and my family gets the money back, presumably tax free because I got to step up in basis. So this is the best way of doing it, but dying with it, that's kind of hard to stomach. There's, a lot of challenges with that. You got to time that and all that. So what's another way to do it, right? Well, in my illustration that I showed you earlier, which I'll track back to, I am doing what's known as a lump sum rollout, where I recognize 2 million of dividend in 1 year, and then I take a loan for 400,000 to pay the taxes from the life insurance policy. That's one way, and it is probably the least tax efficient way of doing it. I've illustrated it right here. This is on paper. In reality, you wouldn't actually do this, but you would do phantom dividends or cashless dividends. But I take 2 million from the policy, pay back the loan at the MSO, and now the MSO has 2 million in cash. And then, in fact, I can do the laser pointer here, I think. MSO has 2 million in cash. MSO then dividends the 2 million in cash from me to me. I then pay 400,000 in tax, and I put 1.6 million back into the policy. Great. Easy. Another way of doing it is the crawl out, which is exactly the same as the lump sum, and this is arguably the smarter way to do it. We just do that dividend over time, chunks at a time. And in fact, in reality, what I would actually do is I would plan the dividends based on my income. So if my income was down, I would do some dividends to pay out the loans. If my income was high, I would skip that year. So that's really the best way, is the crawl out and do it over time. So again, the same basic structure, except took off a zero. So move 200,000 to the MSO, 200,000 from the MSO goes to me. I pay 40,000 in tax, and then I put 160,000 back in the policy. Easy, straightforward, right? So, final point. Lightning round, right? No, just kidding. Final point in this. Well, what if they already have a C Corp? This is fantastic if they already have a C Corp, right? Because if they already have a C Corp, they already have the structure in place. And so if you've got a C Corp with retained earnings, you should just do the split dollar, right? A lot of C Corp owners don't want to take the money out. They don't really need the money. They don't want to take it out. So if you find yourself in that situation, Well, then you just do the split dollar. You do the equity transfer. So we take the retained earnings from the C Corp, put it in life insurance that's owned by the business owner personally. That's going to grow tax deferred. They can take it out tax free later on. And now we are using those corporate dollars personally. Huge benefit if they already have a C Corp. So who's the fit? Who's a fit for all of this? Number one, they gotta have high income. This doesn't make sense if they don't have high income. If their income is not at least 500,000, I don't think we should even talk about this, honestly. In addition to that, we're really looking for people that have a somewhat longer runway, right? Like if you need to take money out of this policy tomorrow, this isn't going to work. You need to have a deferral of, I would say, at least 10 years. Ideally, the longer the better, but 10 years is good enough. In addition to that, I mean, if you're going to move money and set up the C Corp, I would say that we really want them to move at least 100,000. I don't really think it's worth it for less than 100,000, but at least 100,000, I think makes a lot of sense. Obviously they have to be a business owner, of course, have to be a business owner. So that's where I would be looking. Doctors, independent doctors, physicians, that sort of thing is perfect for this. Professionals are great for it, lawyers, things like that. Um, Anybody that's got a very high income, this makes a lot of sense for them. So with that, I'm going to put my contact information up here. Feel free to reach out if you have any questions. I'll stick around for any questions, but feel free to shoot us an email. I've got a booking link in there as well. Feel free to utilize that to sign up with any additional questions. We will be following up with everybody on this, but hope you enjoyed this. Hope you found it interesting. Went through that kind of fast, but it's really one of those conversations that we should think about your clients and talk about specifically your clients and their situation. And I usually like to involve the CPA as well, but let us know if you have any questions and feel free to reach out with any additional information that you'd like. Thanks, everybody.